Mr. Gupta, I'm going to begin with you. The CRR cut of a half percentage point, which essentially returns about 32,000 crores to the banking system. If you could give us just a rough calculation of how much comes back to SBI and how much, to what extent the bank really stands to benefit on account of this.
Well, our deposits are about 10 lakh crores and 0.5% of 10 lakh crores is about 5,000 crores. So State Bank gets a release of about 5,000 crores on liquidity, and obviously that adds to funds that can be deployed profitably. So given a return of about 10%, that's a 500 crore to the bottom line in a whole year.
Quite a few risks also, Mr. Gupta, have been mentioned by the RBI governor with respect to the sovereign debt concerns in the EU, the current account deficit widening, the global energy prices, as well as the inflation remaining high on the back of structural imbalances. From 3 or 4 of these, which would you believe would remain as the key and the biggest concern?
But that's definitely a difficult one. But I think the governor has been very clear in spelling out that the current action of Reserve Bank is consistent with its stance on inflation while addressing immediate concerns for growth. But the eventual relief will have to come structurally, whether it is for protein-related foods where inflation continues to rule high, or capital formation and investment into productive areas. So I think really it is structural levers which will give us relief going forward. A monetary policy can only do this much to keep things going while the major long-term measures kick in with permanent relief.
Also, okay, let me also introduce to this discussion we've got with us Shanti Ekadbaram, the Group Head Wholesale Banking at Kotak Mahindra Bank, also who joins in. Shanti, your first reaction to the measures that have been doled out by the RBI this time around, a 50 basis points cut in CRR. Would you say that has come in on expected lines?
Yeah, hello. It's got cut off. As far as the CRR is concerned, I think that's definitely something that the money markets would feel very happy about because it eases the liquidity pressure. It's got cut off, I think. And so that really is a good thing from the market perspective. It will address the tight liquidity conditions, but I think this is just the beginning. I think a number of measures have to be done in order to ensure fiscal consolidation. I think the governor spelled it out very well. If we have to encourage inflows, if we have to encourage capital formation, I think fiscal consolidation measures by the government in the budget are extremely critical to ensure that there is a follow-through of this policy. I think the concerns on inflation are really correct, and how much extent this gets nullified as we go into the next 6 months is critical.
So Deepak Parekh, Chairman of HDFC, joining us on the show. Mr. Parekh, your first reaction to the half percentage point cut in CRR?
Well, this was expected. As you know, for the last 4 to 5 months, commercial banks put together were borrowing 1 to 1.5 lakh crores on a daily basis from Reserve Bank of India. So Reserve Bank had to release some liquidity in the market to reduce our bank's reliance on overnight funding from the Reserve Bank. I also agree that it may be a little premature to look at interest rate cuts. The reduction in inflation, particularly the food inflation, has to be sustainable, and I'm sure that the Reserve Bank will consider it at an appropriate time. So I'm happy with this, and I think it's a step in the right direction.
Right, but Mr. Parekh, how concerned would you be with the RBI's revision of the GDP growth target downwards from an earlier number of 7.6% to 7% now?
Well, we have to face it that we had a very bad Q3. Q3 in India was bad. And I'm very hopeful that the fourth quarter, the last quarter, will be much better than the previous quarter. And we are still hoping that we will be able to inch up to 7.2, 7.3 during the financial year. We have to see how this quarter rolls out. But I think it is expected that India's GDP will be around between 7.3% during this year. So it's nothing new, and Reserve Bank has to take the cautious approach The government expectation was 7.5%, while Reserve Bank is 7%. So I expect somewhere in between, the year to end somewhere in between. Okay, thank you.
And Mr. Parekh, one concern flagged off by the RBI has been the current account deficit likely widening further from here on. The concern about capital inflows becoming a big challenge for the country. How are you viewing that?
Well, again, I would say that the capital inflows really dried up during the last 6 months, 5-6 months. FII withdrew money, fresh money did not come in. FDI money did not come in the last quarter. We got the FDI in the earlier part of the year. But come January this year, I've seen very positive signals from the foreign investors community, particularly that the rupee has strengthened again, and it was a short-term phenomenon of rupee coming down to 54.20. So I expect capital flows to start coming in, and it has started. In fact, the FII has pumped in about $1.5 billion in January. So I'm not too concerned. I am reasonably certain that we will see FII inflows into India in the current year.
Nitin, Rakesh, if I could come to you. We saw banks as a pack being badgered by the equity markets just in the last quarter. Now, today we are seeing a return of investors into bank stocks. Would you say that a re-rating of bank stocks or the banking pack has begun as we approach a scenario where rate cycles are going to go down, even if the NPA concern remains for investors?
I think clearly the pricing on the bank stocks was discounting a fairly gloomy scenario. So any positive signs from the RBI, for example, the CRR cut, and the early signs from third quarter numbers of the private sector banks have clearly put to rest a lot of those concerns. And banks are definitely coming back into flavor as a counter-cyclical play on the interest rate cycle. So clearly, I think that seems like a good place to be in for the next few quarters.
But Samiran, wanted to bring it to you with respect to a bit of a disappointment. I would think that the inflation projection this time around has been retained at 7%, and the RBI governor saying that it's likely to show some moderation only by FY13. What would be your inflation projections going forward, and don't you think that this would be a little bit risky at this point?
Yeah, I mean, if you look at all the 7 risks highlighted by the RBI governor, most of them actually are connected to inflation than to growth. The growth risks are primarily coming from outside the country, whereas most of the inflation risks are coming from within. So although we are also going by a baseline forecast of about 6.5% for FY13, we understand that there are considerable risks surrounding this view. That's why it's not a very high conviction view of inflation moderating in FY13. We will have to keep a close eye on this, to what extent commodity prices globally come down because of global growth slowdown is something which will be a key factor driving inflation in FY13.